From the Volcker Alliance and the Penn Institute for Urban Research, this is Special Briefing. I'm Bill Glaskell at the Alliance, and I'm here with my co-host at Penn IUR, Susan Wachter. Hello, Susan.
Hello, Bill. Good to be with you again.
Likewise. Glad to hear from you from Washington, uh, America's tormented capital right now. We're coming to you less than 2 weeks, in fact, from America's big day at the polls, and we'll be back on December 5th at 4 p.m. Eastern to review the election outcome and what it all means for states and localities. But today, we're going to revisit the nation's growthiest areas and those growing less quickly as the post-pandemic recovery parties on. And we've got a great expert panel to tell the story. From Rochester, Minnesota, which is knocking the wool socks off the Twin Cities and job creation, please welcome Mayor Kim Norton. From Atlanta, the longstanding growth center of the South, we have Georgia's state economist, Bob Buschman. After Bob, Eric Kim of Fitch Ratings will zoom up to 30,000 feet for the big picture on the recovery and how state budgets are faring, and for the perspective from the $4 trillion municipal bond market. We'll hear from Tom Schuette from PIMCO in booming Austin, Texas. We'll get started in just a moment, but first this word. We're coming to you live on the Volcker Alliance and Penn IUR websites, and also on the Special Briefing podcast on all the big platforms. We've taken your questions in advance, and we'll address them later in the program. And of course, this special briefing is made possible with the generous support of the Volcker Alliance and members of the Penn IUR Board of Advisors. And now down to business. We're going to hand the mic over to Mayor Kim Norton to kick us off. According to the Philadelphia Fed's monthly state economic indexes, much of the Midwest has been cooling this year, and that includes Minnesota, but not Rochester. Mayor Norton, give us an update, if you would, on the Mayo Clinic's role in this growth spurt and their huge investment in the city and the impact on residents and how you're running the town. Mayor Norton. Mayor, if you would turn on your camera, that'd be great. Are you hearing us okay?
I was having trouble getting the camera to come on. My apologies.
That's okay. It's the Zoom devils. Don't worry about it.
Well, you've set me up in competition with the Twin Cities, and that's a little frightening. So just for perspective, some of you know, Rochester, Minnesota is the third largest city in the state of Minnesota. Rochester is about 75 miles south of the Twin Cities area. And we're home to the state's largest employer, which I'm sure we'll talk about, the impact of healthcare and on the economy. But Mayo Clinic is housed in Rochester, and our state and, of course, city's largest employer. And we have been working for several years on a partnership. Mayo Clinic, the state of Minnesota, the city and county have partnered with a program, you would call it, called Destination Medical Center, which involved support from the state for growth in our region, and particularly surrounding Mayo Clinic. So we've been really focused on rebuilding our infrastructure, not only streetscapes and looking at social equity and how can we create our streetscapes, but also looking at the infrastructure underground as we're a growing city. And we have been growing. We're going to continue to grow. And this Destination Medical Center initiative was predicated on that growth, which said that private investment will benefit the state. And for that, we should be supporting Rochester. And in fact, pleasantly surprised to see the latest numbers. Rochester indeed continues to grow. And as you pointed out, we have very low unemployment, about 2.9%, and our job growth has been rapidly increasing. And we had about, I think the latest numbers I saw were about 7,800 jobs this past year, which is over a 6.3% job growth in the past 12 months. That's according to some state numbers. I've seen numbers at the federal level that are slightly different than that, but the message is the same. We are growing. We do have job starts, and we're leading the state in that area. So I think part of that, as we've talked about healthcare and how important that is some of this growth is not only because of Destination Medical Center's initiative and work, but also Mayo Clinic's recent announcement that they were going to invest probably it's $5 billion and probably will be more than that when all is said and done in buildings and really transforming healthcare with development in our community. And so, of course, that kind of announcement that came out just about a year ago certainly hasn't hurt the area as we think about transforming healthcare and what that means for our community. And this is the largest public and or private project in the state of Minnesota. So it's big. We're thrilled to have the #1 hospital in the world in our community. And we know that these changes and this growth are going to bring in not only in the short term construction work and construction jobs. And you may or may not know, I don't know if we've talked about this before, but we won a $1 million Bloomberg Philanthropies grant to buttress that workforce need, focusing on BIPOC women in our community. So we've been working on that, knowing we're growing. Also, the Inflation Reduction Act is causing investments across the country, and we'll be participating in that growth as well. So a lot has been going on in our community, and we are really working hard as a community as a city, I should say, to figure out how can we work with within Mayo Clinic's growth and buttress our staff and in order to support that, because it takes a lot of staff time and energy as a city to work with Mayo and other industries as they continue to grow. So we're in a sweet position right now, maybe slightly different than some other areas are witnessing. We're pleased about that, and we're doing what we can to encourage continued employment, growing our base. I would say one of the things I think we'll talk about later is the challenge with housing. And knowing we've already had a housing crisis, we've been working on it since I've been mayor for the last 6 years. And now with this, these recent numbers, knowing that we're growing, the data shows that we're growing, we're employing more people, where are they going to live? And that is going to be a challenge for us moving ahead as a city is dealing with that. And the other thing that maybe is worth mentioning is we also have a very unique university in downtown Rochester with the University of Minnesota Rochester, which is also small. It's one of the 2 newest universities in the country, focused totally on healthcare. Has some really unique programming, college in 3, and they're actually graduating students in less than 3 years and researching that as they grow. But we're now at 1,000 students, and so that population continues to grow as well. And again, more housing challenges as we we're a non-traditional school. We don't have dorms per se. So, right, the community has to also find housing for that group of individuals. So I would just say we're all working on partnerships. How can we as a city partner with our private, employer, nonprofit, not-for-profit in town, as well as all the other entities, including Chamber of Commerce's and others to grow and grow well and grow and have that growth that benefits our whole city. So I will leave it at that and happy to come back to some further discussion as you desire.
Well, thanks very much, Mayor. And we will get back to some of the questions about how you finance all this growth and where the shortages are. But right now we're going to switch to Atlanta and hear from Bob Buschman about Georgia and the region. Very fast growth, but unfortunately lately some fatal and tragic and hugely expensive storms. How is this balancing out? Number one, how are all the storms affecting your economy, and what are the growth spots and the challenges that Georgia is having right now?
My video is not. I'm shut out of video, so somebody needs to release that hold. There we go.
There you are.
Okay. Good morning. I think we're probably going to get to the hurricane a little bit in the Q&A at the end, so I was going to talk more generally. I'm as an economist about the economy and revenues and those sorts of things. So I'll start off with just a quick update for those who don't track Georgia closely on how Georgia is performing economically, then on what's been driving our general fund revenue growth in recent years, which has allowed us to accumulate large reserves while also budgeting necessary general fund spending growth and making needed one-time investments in infrastructure, technology, and other areas. So since the last quarter before the pandemic, Q4 2019, Georgia real GDP growth has run 2.4% per year on average, slightly better than the 2.3% average for the nation. And though we had our own soft landing in the first half of 2023, we're up 3.5% since then, compared to 3% for the nation. Job growth has also outpaced the nation for most of the expansion, though we're about average on that score over the last year, while our unemployment rate made an all-time record low of 3% in 2022 and was still at 3.1% this April. As of September, we're still 0.6 of a point below the national rate. These strong labor market conditions enabled real personal income in the state to grow by 10% cumulatively from the fourth quarter of 2019 to the second quarter of this year, while real wage and salary income has grown cumulatively by 12.3%, again comparing favorably to national growth of 9.2 and 8.1% respectively on those two measures. Add to that the effects of inflation on both taxable income and taxable consumption spending, plus a consumption shift during the pandemic from non-taxable services to taxable goods spending. We've seen state general fund revenues grow by 42% from fiscal 2020 to 2024. With these revenue gains, we've increased baseline spending to keep up with needs, including healthy pay increases for educators and for all state employees, funded one-time investments, as I said before, and injected $500 million as the first of a three-step plan to boost funded ratios for the state pension system. In addition, we've enacted permanent income tax cuts, albeit so far modest ones, accelerated the schedule for additional planned rate cuts by 1 year, and we've been able to fund 2 tax rebates of about $1 billion each so far. The governor and legislative leadership announced just this Tuesday another $1 billion tax rebate. After all this, we've added $2.8 billion to our revenue shortfall reserve, which has been sitting at the 15% statutory cap for the last 4 years, and we've accumulated $11 billion of undesignated reserves on top of that. Now, Georgia is a fiscally conservative state with a fiscally responsible governor, and he and the legislature have been prudent in managing these good times, careful not to spend down our reserves irresponsibly or turn a structural surplus into a structural deficit. Finally, as for the outlook, I'm in the mid-expansion camp of no soft landing, never mind a recession next year. I'm not calling it a no landing, as I think Mark Zandi did, by the way. I said that the other day, and the governor asked if that means we crash. That said, for the first time in my adult life, the risk I see is domestic political risk and what damaging policies might come out of this election. That risk aside, under a status quo baseline, we're expecting modest growth of the tax base, but without the inflationary boost we've had in recent years. Though the tax cuts we've enacted have made the year-to-year comparisons on income taxes negative for much of this year. Fiscal year to date, through September, personal income taxes are down 1.8%, though the rate cuts that took effect this year would suggest about a 6.25% decline if incomes had only been flat. Sales tax revenues, meanwhile, are up 3.6% year to date. These two taxes account for about 3/4 of our general fund revenues, which overall year to date are up 0.4%. So all is well in Georgia, subject to political risk.
Well, thank you very much, Bob, for that upbeat with some warnings, perhaps turbulence, but in terms of the economy, grow ahead. And we will return with some questions, including questions on climate. But for now, let's turn to Eric Kim. Eric Kim is a frequent guest. We're so pleased to have you back, Eric. He is the head of U.S. State Ratings at Fitch Ratings. And Eric is going to give us the big picture, the broad picture for the nation on how states are doing. Eric?
Thank you, Susan, and thanks to the Volcker Alliance and Penn IUR for inviting me back. I always enjoy these conversations, whichever side of the screen that I'm on. So as Susan mentioned, I manage the U.S. state government's team at Fitch Ratings, and I'll take a few minutes to talk about what we're seeing and hearing from states about their fiscal year 25 budgets and what kind of economic and revenue trends we're seeing across the country. I think it's critical to start any discussion about state budgets with a look at the economic environment. The income and sales tax revenue that states rely on is really just a reflection of economic conditions. The economy sets the foundation for state budgets. So we need to understand what's happening in the economy. We want to understand what's going to be happening in state budgets. Now, Bob just provided a really great overview just now focusing on Georgia. I'm going to zoom out a little bit, talk a bit about trends we're seeing regionally, and highlight a few points of Fitch's house view on the economic outlook. So growth coming out of the pandemic has been very, very robust nationally. So strong, in fact, that it beats expectations month after month, quarter after quarter, year after year. I think most economists were anticipating a recession for about 2 years before finally giving up and accepting that the economic growth was simply going to continue, even with the Federal Reserve ratcheting up interest rates above 5%. But the growth's also been uneven. The West, the Southwest, the Southeast have all seen the strongest state GDP growth since the pandemic's onset back in the spring of 2020, while the Midwest and Northeast, including New England, have grown at a much slower rate and trailed national growth. And this is actually pretty consistent with what we were seeing before the pandemic as well. So in the 10 years between the end of the global financial crisis recession and the onset of COVID, it was the West and Southwest again where the economies were outpacing national trends, and the Northeast and Midwest where growth was notably slower. So, as important and transformational as the pandemic was in many ways, when it comes to the underlying trajectory of regional economic trends, it didn't seem to change all that much. If you go down to the individual state level, you can actually see this as well. After the global financial crisis, Idaho, Florida, South Carolina, Texas, Utah, and Arizona were part of the top 10 states for population growth between 2010 and 2019. Those same 6 states are also in the top 10 for population growth between 2020 and 2023. So what we expect to see going forward, at least in the medium term, is these general regional trends continuing. But the pace will slow down at some point. What we saw coming out of the pandemic doesn't seem sustainable over the long term. Heading into the pandemic, U.S. real GDP growth was about 2 to 2.5%. But over the past year, we've seen growth in the 3 to 3.5% range. So that gap should close at some point. It's just not entirely clear when. Consumer spending, which is about 70% of the U.S. economy, continues to outperform expectations. And there's not really any sustained evidence yet that it's going to slow down considerably. Fitch's last quarterly global economic outlook, we published that just over a month ago, forecasts steady economic growth in 2024 at 2.5% for U.S. GDP growth, and then a slowdown in 2025 to 1.6%, with unemployment ticking upwards next year as well. I will say that in just the month since we released that forecast, we've seen some pretty positive data, particularly as it relates to consumers, and some upward revisions in the historical data, suggesting that the economic growth might be stronger than we're expecting. And we will do a new quarterly economic outlook in December, so be on the lookout for that. Just one data point, the latest GDP Now estimate from the Atlanta Federal Reserve Bank actually has real GDP growth in the third quarter at 3.4%, which would be ahead of the 3% from the second quarter. So what does this all mean for state governments? How are we seeing this play out in their fiscal choices? Every year, Fitch publishes an annual report summarizing the budgets enacted by states. We highlight the different trends and talk about the credit implications. And the dominant trend we saw in this year's budget is a return to normal. Over and over again, we heard from states and saw in what they actually did that their fiscal conditions are coming back down to earth. states are anticipating that most revenues will be back on a pre-pandemic trend rate, and the expenditure pressures that existed before the pandemic are the expenditure pressures we are seeing now, with Medicaid being a really important one. Now, one trend we noted back in January and February was that we were seeing governors present budgets that had deficits that needed to be solved. And that was the norm before the pandemic, so it's not surprising to see that emerge again. The key for state and local governments is going to be dealing with those normal current services budget gaps, getting ongoing spending to match up with ongoing revenue. Things were very strained for governments here in the US coming out of the pandemic. Just like the economy as a whole, tax revenue growth kept outperforming expectations, so states ended up with large revenue surpluses. One thing that did was allow state governments to build up large fiscal buffers. Now, I want to make a point here about how those buffers and how we think about them. There's an analogy that I heard from Zach Jackson, a former budget director for the state of Indiana, and I think a former guest actually here on the special briefing. So we look at state balances in two ways. You've got what Fitch calls dedicated operating reserves, which are a bit like your family savings account. That's the money that is put aside to deal with unexpected events like an economic downturn. Many states informally refer to this as their rainy day fund or funds. Then you've got ending balance, something like your family checking account. This is what the states use to cover normal budgeted expenses. And in very good years, that balance can balloon up, but we expect that it will be spent down, hopefully on one-time items. And that's exactly what we're seeing in the majority of states. Looking at data from the National Association of State Budget Officers, or NASBO, we can see that the total fund balances, which combines the dedicated operating reserves and the general fund ending balances, are trending downwards, while dedicated operating reserves, the rainy day funds, they've been increasing or remain relatively stable. Just looking at the median for total fund balance as a percent of spending, that's gone down from its peak in fiscal 2022 at almost 35%, down to about 24% at the end of fiscal 24. But the median rainy day fund balance has gone from about 11.5% to just over 13% in that same period. So that decline in that total fund balance, to us, that's not a signal of any kind of fiscal distress on the part of states. That's expected and relatively normal. We're still talking about levels that are well above what they were before the pandemic. We're focused on that rainy day funds, the dedicated operating reserves, and what's happening there. And our expectation is that absent an economic downturn, absent unexpected pressures, that level of dedicated operating reserves is going to remain relatively stable or even increase. So that's the picture of what we're seeing economically on a regional basis and what we're seeing at the state level as well.
Well, thanks, Eric. And we'll return to these some of these issues in the Q&A. Just for context, the median rainy day fund balance, I think, was about 8% before COVID. And what's interesting about that is that states seem to have learned a lesson from the Great Recession, the financial crisis, the COVID crisis, that they need to keep more of a safety buffer, because you kind of never know when these shocks will occur. So we'll come back to that in a second. But I just wanted to remind you all that you're tuned in to Special Briefing from the Volcker Alliance and Penn IUR, and the archived editions of this and all of our special briefings are on both of our websites and the Special Briefing podcast. And now, without any more ado, let's switch down to Austin and bring on Tom Schuette at PIMCO. Tom, we've seen a ton of muni bond issuance, maybe a record this fall, as the Federal Reserve has started to cut interest rates. Is this an affirmation of the American growth story that we've been hearing about so far in this episode, or something else afoot?
Sure. Thanks, Bill, for having me, and thank you, everyone, for joining. So yeah, I can definitely answer that, and I think a lot of the context I'll have will piggyback nicely on what the other panelists have said. So I can kind of start with PIMCO's outlook and then dive a little bit more into state and local issuers in the market, and some thoughts on fast growth versus slower growth or even no growth parts of the country. So at PIMCO, we definitely think it's a great time to be a muni investor. I think, as you mentioned, 2024 has been a great year in terms of supply. I was looking this morning, and I think we've had $40 billion monthly new issue calendars for like 6 of the last 7 months. So far in 2024, I think we've already outpaced total issuance from 2023 and 2022. September and October particularly have been exceptionally strong months in terms of governments issuing new debt. And then as an investor, it's been great because we've actually had a little bit of a backup in rates. So a really attractive time definitely to be in the market and buying munis. And then on top of kind of supply, is already kind of been mentioned by the other guests. I mean, we really do have kind of this Goldilocks backdrop from a credit standpoint. So at PIMCO, I help run our credit research team that looks at kind of the credit quality of state and locals, higher ed, public utilities, things like that. And I think you've had this confluence of events that's already been discussed. You had the federal aid, came in with the expectation of being needed to stave off massive job losses within the public sector. And then you had the upside revenue surprise that kind of made some of that federal aid able to go to one-time uses and different things instead of trying to just kind of backfill and keep employment roles where they're at. And then we've had kind of a nice gradual flight path back to reality, as some of the other guests have said, of revenues coming back to this more kind of sustainable, predictable path. But during that glide path, we also had a couple of really big things happen. We had pension funding across state and locals hit a 2-decade high. So we've had even a lot of the outliers like Connecticut, New Jersey, and Illinois either fully fund actuarial demanded contributions or at least chip heavily away at the gaps that existed. And as Eric mentioned, we've seen reserves accumulate not just at the state level, but certainly at the locals as well, which I'll get into a little bit more. And then lastly, I think you had this kind of pent-up uncertainty over certainly inflation, which we've all dealt with, uncertainty over commercial real estate's impacts on revenues, uncertainty over what some of the state tax cuts and rebates might mean for underlying state-dependent issuers. And so what that bred, I think, was a lot of caution on the part of policymakers and elected officials that's really kind of allowed kind of prudent decision-making to kind of flow through. So all that has resulted in, I think we're at like 14 or 15 consecutive quarters of upgrades outpacing downgrades across US public finance, which no one would have predicted, coming out of the pandemic. We see local governments running like 3-to-1 upgrade to downgrade from one of the rating agencies. I won't mention which one. And we continue to see property tax, which is certainly the workhorse of local governments, kind of just chug along. I think the last data I saw still had property tax revenues up mid to high single digits over the same period last year. And I think at PIMCO, we think, given the well-chronicled imbalance between supply and demand in housing, you still got room to run of probably appreciation and assessed values catching up with where market values are at. So a really stable outlook for property taxes, even in the slow and no growth areas of the country, not just in kind of the supernova, Nashville, Austin, Seattle kind of cities. So yes, we're starting to see out-year gaps emerge, as Eric had mentioned. And unfortunately, governments have to solve their budget issues in public, unlike corporate boards. So you tend to get nasty headlines and alarmist press. So I think there's this tendency to look at headlines on something like the city of Chicago dealing with budget gaps and extrapolate that to the entire public finance sector. And I think we see that is really misleading. I think in 20 plus years of doing this at a rating agency and also on the buy side, I would argue that I've never seen the public sector so well prepared for any turbulence or kind of volatility on the revenue or expenditure side as they are right now. So kind of going into the growth idea, growth matters, but it's one variable in a really big cauldron of inputs that determines credit risk, credit quality, and how the muni market kind of looks at your bonds. I was just kind of looking back over the last couple of weeks at some issuers that have sold. I thought, I'm not trying to pick on Ohio here by any means. I like Ohio a lot, but Dayton sold recently. Dayton's fascinating. It's 137,000 people, which is down almost 50% from its peak population. It's just been a sustained run of population loss decade over decade. You've lost major employers, starting with the auto industry and bleeding into National Cash Register and some other big kind of big taxpayers leaving. And despite that, they've held on to AA ratings, and they sold debt that priced consistent with that, like 20, 30 basis points off AAA scale. They're sitting on reserves that are about 50% of their revenue base right now, and they entered the pandemic at about 30%. So this is a city that has dealt with tremendous strains on the demographic front and the growth front for a long time, and is still managed incredibly well. Cleveland, similar story. Sold recently 20 to 30 basis points off AAA. Income tax, at the beginning of the pandemic, we looked at Cleveland and thought, well, 90% of your workforce pays the income tax in the city in their non-residents. And income tax is the primary revenue driver, like most Ohio city governments. And we were really worried about what this would look like with work from home and, the finance sector potentially cutting jobs. Cleveland's posted 8.5% gains in income tax over the last 5 years, expects 3% growth this year. Remarkable story, again, similar to Dayton, $400 million in reserves, which is about double what they came into the pandemic with. So remarkable story again. Just to vary it from Ohio, I'm from St. Louis. St. Louis, really similar story, lost essentially half their population between 1950 and today. Despite that, rating agency upgrade, something that I think the city would openly admit probably they didn't think was possible a decade ago, but just really well managed in terms of growth. So with all that being said, demographics aren't necessarily destiny in terms of kind of credit quality and credit risk, maybe over a long enough time scale. But with a lot of what we're looking at, you have a lot of really good management teams that have made smart decisions in how they manage scarce resources. And so what does all this mean for the muni market? I guess just kind of close it out. I don't think a lot, to be honest with you. We certainly don't see any sort of near-term cliff in terms of credit quality. You might have a downgrade cycle if the economy really turns, but we're not talking about something that's, distress or default cycles. We expect issuance to remain like relatively range bound. If you look back, the muni market's kind of fascinating. As I said, 22 and 23, we actually saw less issuance than I think you did a decade ago. So I think you had like $390 billion of primary market issuance then versus 400 in 2015 and 450 or something like that in 2016. So the muni market just kind of bumps along and you get this kind of range bound issuance. And if you actually look at the amount of total debt outstanding across the last 10 years or so, you've seen about a 60% growth in corporate debt outstanding, much bigger growth, I think, in mortgage-backed securities and treasuries, certainly. In the muni market, in that time is like a 3% growth rate. So it's just like, munis chug along with, they fund the bread and butter, the schools, the things you expect, and they self-amortize. Most of this is, you're not relying on new issuance to pay off old issuance, you're paying it with recurring revenue streams. So that and a lot of federal aid still sloshing around, I think bodes for a pretty kind of stable muni market for the year to come.
Well, thanks, Tom. Susan, you want to kick
Tom,
off the question?
Yes, I do. Yes, thank you. I will please do that. And I would like to start with you, Tom. First, with a very specific question. That's 3% growth. That's a very interesting number. Is that inflation adjusted or is that a nominal growth?
I think you're muted, Tom.
Gotcha. On the total amount of muni debt outstanding?
No, you said there was growth of about 3% a year, which is much less than the growth of securitization, for example, and treasuries.
Oh, no, I was saying it was a 3% growth over time of the total amount of muni debt outstanding. So if you look, right. I think it's a SIFMA stat. I'm honestly not positive if it's real or inflation adjusted, but it's just looking at the total amount of fixed income classes of debt outstanding.
I guess it's nominal and would be therefore under
right.
Which raises two questions for you, and then let's turn back to the broader group. This year, there's been a huge issuance. Is that maybe even a record? Is that true?
I'm not positive it's a record. We've had a great 2 months, but yeah, I'm not positive.
And so why? Is this a bit of a catch up? Is this new issuance, or are we buying ahead of next year because of perhaps expected turbulence in markets or worries about markets? Where do you see that growth?
I think if you look back at 2020 and 2016, I think this has been a somewhat of a common trend of issuers trying to pull forward debt that they would maybe have otherwise planned for November, December, even into early next year, into just before the election, just to kind of play it safe. So I think that's certainly a trend that I think we're seeing play out again, especially, you have not just state and locals, but higher ed, healthcare.
Right. So and I want to go back to you, Mayor, and more broadly on this question, but one thing that's kind of striking, this overall positive to quote you, Tom, never so well prepared for volatility. Always one worries when there's so much positive, but it sounds like there is actual good preparation, and that the coffers are full on some level for state and local, and yet there's great issuance again of debt. And so what's different? What's different is that interest rates are so much higher, and yet I don't hear any concerns in terms of financing costs, in terms of challenges. Yes, challenges in infrastructure needs, and I will please confirm, folks on the panel, correct, that infrastructure needs are not fulfilled, and perhaps labor supply not filled. But in terms of ability to finance, despite higher interest rates, and to go to markets to finance, it's there. Comments, perhaps starting with you, Eric?
Yeah, and please, panelists, unmute yourselves so we can have a discussion. Eric, I'm sorry.
No, that's quite all right. So to Tom's point, and part of your question, Susan, yes, we also think, looking at state governments, that they are very well positioned to deal with the inevitable economic downturn that's going to come at some point. Reserve levels, the things that they've done coming out of the pandemic, also in terms of paying down liabilities. Look at a state like Illinois, that was in the BBB category from Fitch, and made some really, really good progress in paying down its backlog bills, getting to basically a normal accounts payable, building up its reserves to about 5%, still relatively low for a state, but much, much better than it had been before. So now it's in the A category from Fitch.
Let me ask a related question for Eric and Mayor Norton. Actually, it's for everybody, but start with Mayor Norton. You sketched out a real growth story, began to talk about some of the challenges. So some of these challenges, like housing, having an adequate public safety program, teachers, this all has to be financed somehow. How are you going to meet this challenge and meet the challenge, for example, of building enough workforce housing and having enough school capacity and teachers?
Well, I appreciate that. And I would say I really appreciated Tom's comments about public sector being well prepared. And it's something we've worked at very hard in the city of Rochester. We have historically had a AAA bond rating. We continue to have that and work hard to maintain that, because it's good for us as a city when we do need to go out for bonds and loans. So that's part of it. In a growing community, and we've talked about this, I think, in the past, we're growing more quickly than the revenues are coming in. And so we still have to provide fire and police and public, all the public services that a city provides before perhaps the coffers reflect that growth. And so it's a bit of a challenge. We did have a levy increase this year. Initially, it was going to be over 10%. The city council made some cuts. We do a 2-year budget. So this was just a midterm adjustment. To get it under 10% levy increase was an amount of tax increase that people had, which is really a tough thing to talk about as a city, to help the community understand the economics of, city funding, and that we did have to have an increase. And that, that's going to be part of the challenge as we move ahead is we have to maintain a balanced budget, and we do, and we will, and we're very fiscally responsible, but that growth does mean more services, and sometimes it's reflected in a tax increase, as it is this year, but we're going to manage it as best we can. The housing issue, we've changed codes. We're doing everything we can to encourage and incent with tax increment financing and other tools that development. But we also know that affordable housing is difficult to build. So if we just build housing and we have some churn in the industry, that will help free up some housing. And there's policy changes we may need to think about. We have a lot of corporate-owned and individual-owned houses that are turning into rental properties that take them off the market for those young families who are looking for housing. And some cities have moved ahead with policy changes on that. We have not yet, but we are watching that, because it is impacting folks' abilities to get equity in a home, which is really important for individual families.
And Bob, we mentioned very briefly hurricane damage. Uh, what's the impact on the budget and reserves, not just in the short term, but in what the state and your neighbors need to do in terms of improving your infrastructure, hardening infrastructure, if you will, to resist future extreme weather?
Well, I mean, we're already investing heavily in infrastructure in Georgia. There will be some additional spending as a result of the hurricane. So our preliminary estimates at this point of compared to, say, Hurricane Michael in 2018, a little bit different storm. All the costs of things that you have to spend on to recover from a storm like that have gone up with inflation. So while for Hurricane Michael, we had around $270 million of unanticipated disaster spending, will probably be maybe 3 times that for this storm. Now, a large portion of that can be funded out of fund balances in Department of Transportation and other existing ongoing spending categories. But still, it's a significant expense for the state. We also, after Hurricane Michael, enacted some tax relief to support agriculture and forestry, some tax credits based on replanting of timberland and that sort of thing. Whether we need to do that again remains to be seen. But overall, beyond very short-term effects of possible disruptions to sales tax collections and some of the payments that people needed to make early this month, the impact on state revenues shouldn't be material, really. And research that I've seen on other major storms, Hurricane Katrina, storms of that magnitude, the impact on state revenues has not been statistically significant. Local is a little bit different story because you lose a lot of housing. The value of it does decline, while you're rebuilding. So the local tax bases for particularly residential property taxes could be impacted by this. I don't have an estimate of that. But for some local governments in the harder hit areas, it could be significant. We basically had a giant tornado go up through the eastern third of the state. Georgia Power said recently that for Hurricane Michael, they had to replace 1,700 power poles. They replaced 8,000 for this storm so far. So it's significant. But as far as state revenues, the impact is minimal at best or at worst. And for state expenditures, yeah, it's about 3 times what we spent for Hurricane Michael, but still easily funded out of our reserves and out of existing fund balances in different agencies.
So, Bob, can I generalize
Go
that
ahead.
question?
Go ahead, Susan. Sorry.
Yes, and to ask about infrastructure spending in Georgia, which is a relatively high growth state. Is it sufficient? Do you see it ramping up even more across the board for schools, roads, et cetera?
Well, that's been one of the things that we've been doing with our surplus balances. As we finish a year and realize just how much larger the surpluses have been than what we anticipated in the recovery since the pandemic, we have dramatically increased. It's hard to tell when you get these kind of revenue windfalls, how much of it is sustainable, how much of it is creating a structural surplus, and how much is really just transient. And so we've been very cautious about spending it, but we have made one-time spending increases on particular projects as the need arises, and more so than we would have done probably prior to the pandemic with our revenue shortfall reserve not capped out. We wanted to add to that first. So we have been making those investments, and we will continue to do that out of reserves. As Eric said, too much reserves is not just more of a good thing. We expect to be spending it down. How we spend it down, we're going to be very cautious. Only spend it responsibly. Give back to taxpayers, but invest in one-time investments in infrastructure, technology within government to make government more efficient, things like that.
Thank you. Can I ask panelists in general their outlook for infrastructure spending, and perhaps start with you, Eric, in terms of, and then Tom, what do you see going on right now?
So Georgia's an interesting case because, as Bob was saying, the state has been spending a lot in terms of its fund balances, the built-up fund balance on infrastructure. So much, in fact, that they did not come to the bond markets this year to do the normal bond issuance. So we didn't have the chance to participate there. But I think that's actually something we saw or are seeing in a lot of different states and local governments, is that there has been so much in terms of built-up reserves that they've been able to parlay that into spending on capital needs. There was obviously all the federal resources that have been coming in, coming out of the specific pandemic aid bills, but also coming from the bipartisan infrastructure law. And then we still have the CHIPS Act and the IRA and the funds to flow from that are going sometimes directly to government, sometimes to the private sector to jumpstart investments that are also going to kick into public sector investments. So we see a fair bit of spending coming down the pipeline, whether it's through bond issuance or through cash spending or federal grants or whatnot. There's still a significant pipeline of spending to be had on the infrastructure side, and there's a pretty sizable need as well. I think many of us are familiar with the American Society of Civil Engineers infrastructure report card that they do on a regular basis, and looking at that data, and to be clear, that's coming from a particular viewpoint. The engineers obviously are in favor of more spending on infrastructure, but given that caveat, there are some pretty significant deficits that they're reporting in terms of overall infrastructure that the U.S. is going to need to address in order to get its infrastructure in place and to support economic growth going forward. So I think we definitely expect increased infrastructure spending going forward for sure.
If I can add something, there may also be some political pressure down the road. The Municipal Industries Accounting Regulator, GASB, is working on a better standard for deferred maintenance, which is very geeky, but it's those billions or trillions of dollars of work, bridges, highways, sewage plants, college campuses, whatever, work that needs to be done. When governments actually have to start disclosing a credible number down the road, that may bring more pressure to do something about it, and we'll see. At the Volcker Alliance, we're working on a big infrastructure deferred maintenance project, and we'll have some results on that later in next year alongside our partners at the Pew. So stay tuned. I wanted to get to a question that comes from Philadelphia, Susan's home base. A lot of us love the Philly Fed monthly economic indexes because they're literally pretty pictures. They're heat maps of the whole country. You can see how growth is rising, falling, where it is. Very simple, easy to digest. So Philip Jones at the Philly Fed is asking about two related questions: COVID relief funding as opposed to infrastructure aid and more long-lasting stuff. COVID relief funding is just about over. Is that going to have a lingering effect? Maybe Eric and and Bob can start on that. We'd like to hear from Mayor Norton too, and also how about growth in rural regions versus metropolitan regions? Where are we? Are we seeing similar patterns in both? But let's ask about the COVID relief, because that is a question that's looming over a lot of municipalities that haven't spent their money, or spent their money and have continuing programs that don't necessarily have continuing funding.
Yeah, it's about that idea of a federal fiscal cliff, if you will. That's really about how did governments use the money that they got coming out of the pandemic aid. It was clearly one-time aid. Were governments able to recognize that and dedicate that money to one-time uses, or did they create new programs or support existing programs in a way that creates budget problems for them down the road? I think at a high level for state governments, we think states generally were pretty prudent in what they did with the COVID money, and have positioned themselves well to deal with what happens when that funding runs out. In most states, the challenge is actually about making sure they spend it all the time. They've got to obligate it by the end of this year and then spend it by 2026. So we don't anticipate a federal fiscal cliff for state governments for the most part. I think for some local governments, it gets a little trickier. And it comes down to the question of how did governments use that money, and what are they prepared to do once that spending runs out.
Well, Mayor Norton, how did you spend your it's state and local fiscal recovery fund money, but how did you spend your emergency money, and is there any money left, and are you able to cover needs that were previously being covered by the feds?
Well, I would say we were pleased that money came directly to the cities and local jurisdictions, so we didn't have to go through a lot of time and rigmarole to get it, through the state. So it was very beneficial to get that money into our communities quickly, starting with ARPA and then the CARES Act funds. And I would say we did a little bit of both. We did not spend money on anything. We did not replace current spending per se, but we and start new programs. We did use a lot of the money to assist people early on, getting through the early times of the pandemic. And since then, we buttressed our city budget a little bit, so we eased ourselves out. We chose as a city not to increase taxes at all during the pandemic. We kept a 0% levy. So that was significant for our community, and I think they appreciated that. In doing so, of course, it pushed the need for funding over the next few years up, and we also chose not to lay anyone off during the pandemic in order to support our employees. So so we funded ongoing, or not ongoing needs. We funded just the needs of the pandemic, and then the rest of it we've carefully spread out over the years in order to ease us back into a full budget revenue.
Tom, are you seeing any danger spots looking at your portfolio and your market?
I mean, I think there's going to be issuers that absolutely deal with budget impacts earlier than others. I mean, I think Chicago is the example that most people are pointing to of announcing fairly large kind of current year gaps and out year gaps. So, I mean, my expectation is that a lot of the issuers that probably came into the pandemic in pretty strained positions are going to be the first out of the gate back into, dealing with structural issues. So that being said, I think, still it's the issues and the scale of issues are pretty solvable for even the places that are dealing with issues. I think San Francisco got downgraded the other day, and I think people kind of paint San Francisco's issues, especially on the commercial real estate side, as this insurmountable challenge. And I think it's important to note that San Francisco is still a AA credit and still sitting on, exceptionally robust reserves. It's just they're a little earlier out of the gate in terms of having to kind of make some tough decisions than others.
Susan, why don't you jump in with a question?
So, yes, well, I guess I have a question about the growth that we've seen and the pattern of growth, which is to the south and to the west before the pandemic, and now again, and during the pandemic, and now again. this blistering pace of growth, particularly regional growth, can it continue? Will it continue? Eric, do you want to take us start with that?
Yeah, I mean, the point I was making earlier is that the pace of growth is likely to slow down at some point coming out of the pandemic, but that the places that are growing fastest will likely remain the same ones that were growing fastest beforehand as well. The question of when that pace slows down is again, it's still a little bit unclear. We've been expecting the economy to slow for several years in a row now, and it just keeps beating our expectations. And a big part of that is the American consumer. And again, we don't see signs yet that consumer slowdown is happening in a sustained way that would really threaten the economic growth trajectory. But the growth of 3.5% to 3% in terms of U.S. GDP, it's well above the pre-pandemic trend.
Eric is frozen. Hopefully people can hear me.
No,
So we're good.
we're hearing him okay, Susan.
Okay, I'm sorry. Go ahead. Just on. I'm sorry. Go ahead, Bill and Bob. Go ahead. Yeah.
No, go ahead, Eric. We're here.
No, that's it. That's what I had to say there.
Great. Well, thank you. So let me turn to you, Bob, and the same question for Georgia, and also add on the question that we didn't quite address that came up before, and I want to put a different spin on that, is Georgia is one of the relatively fast-growing states, and in the U.S. as a whole, it's been the suburbs of cities that's growing faster. You see that in Georgia as well, and is the infrastructure needs coming to where the demand is for growth in the suburbs and financing there for that infrastructure need in the suburbs?
Financing of infrastructure. I mean, that's really not an issue for us right now.
Right.
I think, I mean, just from headlines in Atlanta over the last several months, the only significant infrastructure problems that I'm aware of in Georgia are some water issues in the city of Atlanta. Right. But beyond that, that's not really, I mean, it hasn't really been a constraint on growth. Georgia's also not, a blistering growth state. We've outperformed the nation since the pre-pandemic periods, but not by a huge margin. I think I was looking at this just yesterday, just comparisons across the states. There's really only one state that's been consistently top ranked over all periods since pre-pandemic, and that's Washington. Utah's been up there some periods in the top 5, but not always even in the top quintile. Georgia has been comfortably most periods except for 2020. The 4 quarters ending June 2023, we've been comfortably in the second quintile of states as far as growth. So it's very manageable growth. I don't think there are issues of that growth disappearing. We're still growing about 1% in population every year, and we have the funds to build out infrastructure to support that.
Well, I think we're going to probably leave it at that because we're getting to the top of the hour. Not slow, nice and steady sometimes beats frenetic and fast. We'll hear more about this, I'm sure, at our next special briefing. And that's it for this edition of Special Briefing. Thanks so much to Susan Wachter, to Mayor Norton, and our terrific panelists. There's an information slide up on your screen right now where you can contact our panelists if you have any follow-up. Thanks to the Volcker Alliance and members of the Penn IUR Board of Advisors, and of course, thanks to our multi-talented production team behind the camera and the mic, Graham Dowd in New York, Noah and Ritzenberg in Washington, and Arden Jordan and Megan Schmigdal at Penn in Philadelphia. And special thanks to you, our audience, for joining Special Briefing today. We'll be back at 4 p.m. Eastern on Thursday, December 5th, with a post-election wrap-up and look ahead to 2025. So please watch our websites and and your email and social media for details. And remember to catch up on this and all of our other special briefings on our podcast on your favorite platform. And so for now, thanks again to Susan. I'm Bill Glaskell, and we'll see you on December 5th.